Hi there, welcome, and thank you for joining us today. I'm Marche, the webinar director at Advice Chaser. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation today. Attendees are muted, but we do encourage you to ask questions using the chat box, and also if you have comments. The presenter will answer the questions during or after the webinar today as appropriate. And if you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after today's webinar. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Let me go ahead and get his picture up here. Ethan T. Brown has a bachelor's degree in political science from the University of Michigan and an MBA from the University of Massachusetts at Lowell. He joined Cox Capital in 2015 and became a partner in 2020. His primary responsibilities include equity and fixed income research, portfolio management, and meeting with clients. He holds the CFA and CFP designations. Ethan is a former national champion triathlete and an Olympic trials qualifier. In addition to his role at Cox Capital, he sits on the board of directors for the Drake Academy of Excellence. And Ethan, we've had you here before, and we're so glad to have you back. I was just saying how I appreciate you bringing clarities to very complex topics. And I know that we're in for a treat today again. So I'm going to go ahead and turn the time over to you and love to hear what you have to say.
All right, excellent. Well, thank you so much, Marche, for the nice introduction. And yeah, this is, I think, my third or fourth time doing this, so I must be doing something right. I haven't gotten kicked off yet, so I'm happy to be here today. And thank you to Advice Chaser as well. I'll just kind of echo some kind of disclaimer items real quick. I think there may be kind of general concepts or advice in this presentation. It really needs to be evaluated in the context of your own personal situation. Like Marche said, please consult a professional before doing anything. And also please ask questions along the way. I'm happy just to kind of stop and address anything that comes up. But I think we have a really exciting topic to talk about today. There's been a big evolution in the private equity world, and it's quickly becoming much more accessible to the average person. And I think it's going to play a key part in people's portfolios in the decades to come. I think we're at the start of a big trend here. And so I'm excited to kind of go into some of the details and share what's going on here. So first off, just a little bit of kind of defining some terms here. We use private equity in a very general sense, but what we're really talking about is the alternatives asset class. And alternatives covers several different asset classes, including private equity, and we'll define those next. After that, we'll talk about why we think that having alternatives in a portfolio makes sense for people. And again, it's not just, this is in general, not particularly for you personally, maybe, but there's a strong case to be made, and we'll lay it out there. And no discussion would be complete without talking about kind of the risks to doing this, because it comes with a whole different set of risks relative to just buying mutual funds, index funds, and things that people are more familiar with. We'll talk about some suitability issues and kind of this trend that I mentioned of how private equity is becoming more accessible. We'll go into some of the details there and how you could potentially access this asset class. So we've got a lot to cover, and hopefully you'll find this helpful. So starting just at the top here, defining alternatives in general, really what we say when we're talking about alternatives, anything that's not a publicly traded stock or bond. So things that you have a liquid market for, stocks trade on the S&P 500, those are considered public equities, public securities. Alternatives are not traded on exchanges. They're in the private markets. Prices are negotiated between two parties. And so there's a lot of differences. And as we kind of look at the umbrella of what do alternatives kind of cover, I think that the most popular one would be private equity. And when people think of private equity, most people think of venture capital, kind of like companies like, Uber and Lyft in their early days before they were public. And they're raising tons and tons of money, and they're also losing tons and tons of money, but people keep investing anyway because they're going to take over the world at that stage. But it really encompasses much more than just venture capital. You have growth equity, which is a little bit more established companies. They tend to be, and so just backing up, venture capital companies a lot of times are not profitable. You are investing in them, and you might not have any cash flows generated for another 5 to 10 years in some cases. Growth equity is a little bit more established. You have companies that they're trading in the private markets. They're not public, but they are positive in terms of profit. So they're growing quickly, and they simply need more investment to continue to grow at their current growth rates. Buyout equity would be probably the lowest risk category in private equity. And what you have here is typically established companies that have an established manager that basically buys companies, rolls them up, grows them for a few years, and then sells them to the next private equity firm. And these could be just very basic companies. Think of like a landscaping company, an HVAC maintenance company, things like this. You'll find an experienced manager that knows. There's a lot of these companies that have sellers. Maybe they're in their 50s, 60s, thinking about retirement. So they'll make an offer. A lot of times these businesses maybe are they're family owned, a little rough around the edges. So these operators can come in. Maybe they implement like an SEO strategy to kind of find more customers for them. They implement a payroll system to kind of streamline all the HR operations. So they make kind of a family business a little bit more professional. And with it, they increase revenue, they increase profits. So maybe 5 years down the road, they can sell it for double or triple what they paid for it, and then provide a good return for their investors. And then there's another category, a fund of funds category. And so there's some private equity funds out there that all they do is invest in other private equity funds. So there might be venture, growth, buyout funds, maybe some specializing in a specific area like healthcare, industrial companies. And so they'll just build a portfolio of other private equity funds. And they typically will have special expertise in these areas. So they know what to look for. They try to find experienced managers with good track records. But so the point there is that there's a lot of different parts of private equity, not just venture capital. And on the bottom of this slide here, you can kind of see two examples: SpaceX, Discord. These are private companies right now. Private markets are enormous, and so we'll talk a lot more about that. But so a lot of household names are probably private companies that you just don't know.
It's interesting how you say that, and I think most people would assume that those are publicly traded companies.
Mm-hmm. Yeah, and we'll talk more about that, but can you just back up one sec to the previous slide? So there's a host of other categories. We have private credit, which is just private companies making loans to other private companies. You have real estate, which I think everybody understands. Within real estate, there can be higher risk development type things, or kind of lower risk, just buy a building that's already leased up for cash flow. And then of course infrastructure, which is like toll roads, airports. These tend to be good hedges against inflation. So there's kind of private funds that just specialize in those other specific areas. So it's a massive market, and it really encompasses pretty much everything. All right, thanks. Okay, then coming to the case for alternatives. So why would you want to buy this stuff? So there's a few structural things going on in the market right now that have made, I think, alternatives more attractive in recent years. So the first one is this phenomenon where there's about 50% less public companies outstanding in the market today than there was 20 years ago. So if you look on this first chart here, you can see around the late 90s, 2000, there was about 8,000 public companies. And this is dipped to a little bit below 5,000 today. And so in some sense, the public markets are shrinking. You've had companies just, in 2000, you had a lot of companies go bankrupt with like the tech bust. But then you've also had a lot of like M&A, taking companies private type of activities. So to some degree, there's a shrinking opportunity set in the public markets. You contrast this with the number of private companies out there. This is the light blue line, and you see that it's really just increased dramatically. In the second chart here, we show that the portion of public companies out there, so that any company trading on the stock market, is really just a fraction of the overall kind of opportunity set of companies that exist. So we're all buying index funds thinking we're truly diversified, and really you've only got 9% of the market. And within that 9%, you've got a massive weight to kind of the Apple, Amazon, Google, like the kind of big tech companies that dominate the market cap in the S&P 500. So it kind of begs the question: are you truly diversified if you just have this, an index of one small segment of what's available out there? So a lot more public company, or a lot more private companies. And then on the final chart here, the growth rate has been a lot faster in the private markets as well. I mean, public companies that are trading on the exchanges, they're typically mature companies. So they're a lot of them are not in growth phases anymore. They're generating a lot of cash flow. There's at the point where they're paying out dividends now. That's indicative of a mature company. And so that's not the case in the private markets, where you may have a lot more kind of growth-oriented capital being invested. And the final point here too is that companies are staying private longer. I think in 2000, when a company went public, the market cap on a company was maybe 500 million. When you look at where they're going public today, it's like 5 billion. So there's all this growth happening from 500 million up to 5 billion that is happening in private markets. And so part of the case is you want to have some exposure to all that growth that's taking place not in the public markets. And then this is probably my favorite slide on here, because I'm kind of a quantitative guy. Marche is making fun of me, but I'll do my best to explain this here. So what you're looking at is several portfolios plotted on a risk and return scatter plot. So you have the expected return is on that vertical axis there. The level of risk is on the horizontal axis out there. And when we're talking about risk, you're seeing these numbers 8, 9, 10, 11%. That's standard deviation. And so it's just a proxy for how volatile a portfolio is. And so on all these portfolios that are plotted on this axis, you've got kind of two sets, one that includes just equities and bonds, and then another that includes an allocation to alternatives, kind of between those equities and bonds. And just to kind of interpret what happens here, if you look at this portfolio that's furthest out on the risk spectrum, 80% equity, 20% bonds, so it has an expected return of about 9.5%, and it's out at about, maybe 12.5% on the risk spectrum. What this shows is that if you add an allocation to alternative assets, if you carve out 30%, put it into alternatives, it has a dramatic effect on the risk profile of the whole portfolio. Not only does it come down from 12.5 to about 9.5% in terms of that risk level or standard deviation, but you're also getting a little bump up in terms of the return as well. So anytime, in finance, if you can get higher return with less risk, I mean, that's a no-brainer. And so that's the real value that some of these alternative assets can provide. They're going to give you hopefully a higher level of return, and you're not going to have to deal with that volatility that is in the public markets, kind of looking at your portfolio every day, seeing things go up and down. And then just a couple notes on why this is. And you can see this is indicative of all three of the equity bond portfolios. When you add alternatives, they have the same characteristic. They become a little bit better on the return spectrum, lower on the risk spectrum. So it's a really strong characteristic. And so essentially, one of the reasons why this is alternative assets they're not priced every day. I mean, you go on and there's a quote for Apple stock every second of every day. A lot of these alternative funds, they're only priced maybe once a month, once a quarter, once a year in some cases. So it's a structural thing where, because they're not trading every second of every day, you're not going to have that kind of volatility and bouncing around. So the inflation numbers come out, the market tanks, these assets are going to kind of stay stable in your portfolio. And so it's a little bit of smoke and mirrors to some degree, because maybe if they did price it every second of every day, they would be more volatile. But for now, I mean, this is just how these alternatives kind of trade. They have very specific kind of entry and exit points, and they tend to just be very stable. So when you look at the kind of return profile over time, it's up and to the right with not a whole lot of volatility along the way. Maybe as alternatives become more popular, they will become more volatile as they get more accessible as just a kind of future risk there. But this to me summarizes the true case for alternatives. You can get potentially better returns, less risk. That's the whole goal of what you're trying to do in your portfolio. And then kind of an aside from the previous slide, I mean, this looks at different asset classes. We have international stocks, bonds, high yield bonds, REITs, real estate investment trusts, and commodities. And it looks at their correlation to the S&P 500 in two distinct periods. You have the light green period would be in the early 2000s. The dark green period is post 2008. And so on that previous slide, one of the reasons that the alternatives had such a strong effect on those portfolios is because they had a low correlation to both stocks and bonds. And you contrast that to what's going on this slide, where correlations in every single asset class on here, and these are all publicly traded asset classes, have gone up between these two periods. So it's especially pronounced in something like public REITs, which, REITs or real estate used to be a great diversifier for portfolios. But since the housing crisis, I mean, the correlation has more than doubled, up from 0.32 to 0.74. So that means, when the S&P 500 is down 10%, you can't really rely on real estate as a hedge to be, flat or only down a little bit. They're going to be down closer 1-for-1 with stocks. Same with commodities. Commodities used to be a slight hedge and a diversifier to traditional stocks. That has not been the case in the past few years. This is a reason why it's getting harder and harder to diversify a portfolio only using asset classes specific to public markets. And that's another kind of case for why you want to look at alternative asset classes, because they have this correlation effect that you're looking for, where they're going to be kind of zigging when the S&P is zagging and providing that kind of balance to a portfolio when you really need it.
We have a question here about bonds and how bonds are traditionally used as a hedge. Why is it that they're becoming more correlated to the market?
Yeah, so essentially what happened in this period from 2008 to 2020 is we were coming off a great financial crisis. And so the Federal Reserve and the government injected a ton of liquidity into the markets. They started a bond buying program. They kind of rescued the banks from going bankrupt. And so with that bailout and all the stimulus and liquidity injected into the system, it had an inflating effect on both stocks and bonds. And really that effect lasted from 2008 to 2022. And we're feeling some of the repercussions from that right now. What's happened this year is, with inflation coming into the picture and the Fed needing to pull back on that stimulus to try to slow down the economy and slow down inflation, they're doing the opposite of what they did from 2008 to 2022. They're taking liquidity out of the system. They're not introducing stimulus. They're introducing restrictive policy. And so you could argue that stocks and bonds were overvalued. And by pulling this liquidity out of the system, and you could also argue that liquidity is what drove everything up and down together. And so now you're seeing that play out, where as liquidity comes out of the system, these correlations are so high, and you had interest rates so low that they stopped kind of acting as that natural hedge. I will say that given how poorly bonds have performed this year, I do think that going forward, they will be a better hedge against the portfolio. But this is all driven from this kind of government intervention that made correlations a lot higher with one another. And it's just playing out this year.
All right, thank you so much. Let's go ahead and move on to the risks of private equity and alternatives.
So right. So there's a kind of a whole different playbook of risks when it comes to investing in private or alternative assets. And I think that the first one that you'll have to get your head around is just the illiquidity risk. So just going back to the example of Apple stock, I mean, if you want to buy or sell Apple stock and it's trading at $150 a share, you can buy or sell probably within a fraction of a cent of that market price. And it's completely liquid. You're not really giving anything up to buy or sell. With these private assets, private funds, private companies that don't really trade every day, you don't have the same liquidity. And so a lot of these funds actually have very specific requirements about when you can and can't take your money back. In very traditional private equity, you have a 10-year lockup period. So you write a check and you're not getting anything back for 10 years. I mean, that's illiquidity at its most extreme example. And so if you do want to try to sell out of one of these funds, you need to sell at a massive discount in order to get out. So any money earmarked for alternative assets, you really want to make sure that that's aligned with the time horizon that you have, because the last thing you want to try to do is sell an illiquid asset. And you just think about, like, if you had 1 hour to sell your car, you'd have to run around to anybody in the parking lot you can find, and you're not going to sell it at sticker price, that's for sure. You're just going to have to find the person with the most cash in their pocket that's willing to buy at that stage. And so you might be having to sell that at a 70, 80, 90% discount just to get it off your hands. I mean, that's illiquidity risk at an extreme example. The next thing we have on here is less transparent reporting. And this is another reason companies have wanted to stay private longer. I mean, when you go public, you have SEC reporting requirements. You need to file quarterly reports, once a quarter, an annual report once a year. And these are really in-depth, they're expensive. Public or private companies do not have to do this. And so there's really just less information available on them. So you can't go and, I can log on to my Bloomberg terminal and read 100 research reports on Apple. I mean, that's not the case with private companies. I mean, you have to, know a private equity manager, know the company management personally to get information in these areas. So it's a lot less transparent. There's a lot less disclosures. And so for those reasons, there's a lot more of intense research involved in the private equity firms that invest in companies like this, because they can't rely on these companies reporting GAAP accounting. They have to go hire their own accountants to audit their books themselves. So there's a lot more difficult due diligence process with private companies. And again, less public research. That's the Apple example. You're not going to find a whole lot of research reports on companies that are private. It's just a fact there. This next one is probably a new term for most people, blind trust risk. So a blind trust, what this means is essentially, when you're investing in a traditional private equity fund, you're writing a check to a private equity manager, and you have no idea what they're going to invest in. All you know is they have a good track record. They've produced returns 20-30% in the past. So you trust them that they're going to make you money. See, you write the blank check and you don't know what you're getting. You're just relying on their track record and hopefully their business acumen to make good decisions. I mean, that's when you're buying a public company and you're typing in AAPL into E-Trade, you're getting Apple. You know exactly what you're getting. That's not the case in private equity. And there's kind of a similar risk associated with this called the J curve. And what this refers to is the fact that, if you invest hypothetically $1 million into a private equity fund, it might take the company a few years to find investments for that money. But you can be sure that they're billing on your money along the way. So your $1 million is going down and down and down until they have a portfolio full of good investments and they start to kind of increase in value. So that down is like the bottom of the J, and then hopefully it's straight up once they kind of fill up their portfolio. But so it's a lot less transparent from that perspective, because you just don't know what you're getting. Pricing is an issue with things like this. I mean, again, in the public markets, most stocks trade every second of every day. There's a lot of buyers, a lot of sellers. So you can, price discovery is very easy. With private funds, not at all. I mean, if you can hire third-party valuation firms, sometimes private equity funds have like their own pricing committees that price their own assets, which is a little bit of a conflict of interest there. So it's a lot more difficult to determine what something is actually worth when kind of the pool of potential buyers and sellers is significantly less. Finally, high fees. I mean, you buy an index fund for 0.1%. That's pretty good. You're not paying that private equity. You're going to be paying the 2 and 20 model, which essentially is they charge you 2% on your assets and then take 20% of the profits that you make. So the fees are significantly higher. Excuse me, sometimes as much as 10 times higher than a regular mutual fund. And they're not as straightforward as just public mutual funds. It takes some percentage of assets. A lot of times there are, in addition to that kind of overall management fee, there's hurdles where if anything over 7%, then they keep 12% of that incremental profit and things like that. You have incentive fees, hurdle fees. There's something else called a high watermark, where the fund needs to kind of be above a certain level for them to continue to take their fees. So it's much less straightforward when it comes to the whole fee structure. And then, of course, tax reporting. A lot of these funds have really complex strategies that require K-1 tax reporting. If you don't know what that is, and you tell your accountant that you have a K-1, they're going to be really angry at you, because it's a nightmare for accountants. It creates a lot of extra work, and lots of private funds are notorious for never getting them out on time. So it's like October and you're just getting your K-1 for the previous tax year. So there's headaches when it comes to that. And then the last risk on here is manager selection. So in private equity, you're picking the right manager makes an enormous difference in your return profile. And it's different in the public markets. I mean, between 2010 2020, if you were a growth fund manager, you manage growth mutual funds, you can be the worst manager out there, but you're buying Apple, Google, Amazon in your portfolio, and those are doing well, so you're making money. And so you look at the kind of dispersion of returns in that kind of growth manager segment in terms of public mutual funds, pretty narrow. When you look at private markets, the difference between a good manager and a bad manager can be like 30% a year, like extreme dispersion in terms of the returns. So you really want to be making sure that you're picking the right person to put your money to work and do it in an efficient manner. Okay, so when you invest in a private equity fund, there are various requirements, and they range from actually now almost no requirements to very, very high requirements. So most traditional funds, you need to be what's called a qualified purchaser, which in order to have access to the fund, you need to have investments exceeding $5 million. So that drastically narrows the pool of potential investors if you have a threshold that high. In addition to that, there's probably minimums of like 250,000, maybe even $1 million in some of the most popular funds. Kind of going below from qualified purchasers, there's this qualified client segment as well, which is a net worth exceeding 2.2 million. You have to have about over $1 million invested with a particular advisor. So it's still a pretty high threshold. Then you get to accredited. And I'd say a lot of the funds now that are becoming more accessible still require an accredited investor status on them. And so this would be needing to have income over 200,000 or 300,000 a year, net worth exceeding 1 million. So there's still pretty high net worth requirements to get access to some of these funds with this accredited designation on them. And then there's one below accredited. I don't know what it's called, but they require an annual income of 70,000, minimum net worth 250K. But I know like Blackstone, for example, which is one of the biggest private equity firms out there, as they try to create kind of private equity and private credit products for kind of the mass market, they have this requirement on there of that 7250 threshold. So slowly over time, I think these thresholds are being lowered for a lot of these funds. Some require no sort of accreditation or anything like that, no net worth requirements. In the past, these protections were placed onto funds, they were placed on funds to protect investors, because they didn't want somebody that had $100,000 in assets, and it's the only money they have, to put all their money in one fund, just to try to meet some threshold, and then they're not diversified because they only have one fund. So they really were protections for investors. But I think as the private equity world is opening up and realizing that they can get a lot of new investment from kind of the mass market, they're trying to find ways to get lower and lower on this kind of accreditation spectrum, and even kind of in some cases wipe out these requirements completely, so that they can provide access to this to just the mass market. So expect a lot more options in this area going forward as funds as private equity firms wake up and realize that there's a lot of new business to be had, just from the mass affluent. So traditionally, like private equity and alternative assets, they were really reserved for more institutional investors. And when we look at this chart here and you look at the allocation to private equity, you see pension funds, sovereign wealth funds, endowments, family offices, pretty big allocations to private equity. And this is only one bucket of alternatives. They probably have private credit, private real estate. And so the allocations in a lot of pension funds and sovereign wealth funds might be 50% in alternatives when you add up all the different alternative asset classes. And think about it, these are institutional investors whose job it is to invest money. So they must be pretty good at it. You look at the average retail person, maybe like you or me, what's their exposure to private equity? It's zero for the most part, because it's never been accessible to that part of the market. But it certainly plays a valuable role in the portfolio as the case we've laid out. So we think going forward, I wouldn't be surprised to see a lot of advisors starting to use some of these options that have been rolled out to get their clients maybe 10 to 15%, as a baseline exposure into alternatives to get them familiar with the asset class, and hopefully take advantage of some of those risk and return kind of profile benefits that we went over earlier. But again, just in terms of suitability, to invest in this stuff that may be illiquid, you need to have a longer term time horizon. You may have to have net worth requirements above a certain level. And you should have some level of education about investing, because you don't want to invest in something you don't know. And certainly if you're not really committed to holding a fund that's illiquid, it's not going to be a good experience for you. So these are just some things, if you're considering this, that you should be aware of. And so as we go forward and talk about the evolution of kind of what's gone on, we wanted to show a little bit of a real life example. And these are a few funds that my firm uses, and so we compare their performance through the end of August to the public markets. And this kind of just illustrates exactly why you want to use alternatives as an asset class. So on this chart here, you can see everything kind of in the green and light green is considered an alternative, has posted a positive return year to date through the end of August. Whereas you look at what's gone on in bonds, down 11%, S&P down 16%. So it really just underscores the point that alternatives really can provide some ballast in a portfolio during a really tough year. And so it's been a great year in terms of just illustrating the case of why they can be such an important building block of a portfolio. And certainly it's given us more confidence, to see it play out like that. When you look at what these funds are, the top performing fund here is Blackstone Real Estate Trust. It's a private REIT that Blackstone runs. And interestingly, if you look at the performance of publicly traded real estate companies or REITs, it's been a pretty disastrous year. And Blackstone, being a private company, has actually went into the public market, bought some public companies at what they felt were attractive valuations, took them private, and so they're now in this Blackstone Real Estate Trust that they have. And so it's kind of a cool thing when they can use the public markets as their shopping list as they're trying to buy more assets. And you see all the turmoil that's gone on year to date in the markets has been a boon for them, because they can buy assets at lower prices. The second one, Stepstone Private Markets Fund. This is just a broadly diversified private equity fund, that they advertise an expected return in the the 12 to 14% range, not guaranteed, of course. But they perform very well year to date, and so far the fund has acted as they said it should. Then the last two, the private shares fund, this is more of a venture capital type fund. Hasn't done as well as the other funds because I think it has a lot of tech exposure, and those valuations have really gotten a lot more beat up this year. And finally, there's kind of a hedge fund strategy on there, a merger arbitrage fund that's kind of a fixed income substitute. That's up slightly, up 1.5%. So just seeing these funds in action in a year like this, I think should illustrate why it can be a great thing to have in your portfolio. Certainly providing a little bit of positive return in a year like this is a good thing. Now back to the evolution side. So what I talked about before, how when you were going to invest in a private equity fund, you'd have to write a check, and you don't see that again for maybe 10 years. There's a new structure of funds coming out. They're called either interval or subscription funds. The minimums can be as low as $2,500, and the illiquidity periods are a lot less. So typically these funds require only a 1-year lockup period, and then they'll offer liquidity on a quarterly basis. So that's pretty good. If you have to wait, if you want to get your money back, you only have to wait a year versus 10 years in traditional private equity. So the way they work is you can typically buy into the fund once a month, and then once you wait that 1-year lockup period, you'll have to submit paperwork on a quarterly basis if you want to take your money out. But it really reduces that big illiquidity risk that we talked about, and I think makes that asset class a little bit less intimidating to the average person that doesn't want to part with their money for 10 years. And so through these interval or subscription funds, you can get broad exposure to private real estate, private equity, private credit, and all the main areas in the whole alternatives bucket. So it really is kind of a good innovative tool that's come out fairly recently, just in the past 5 years or so, but is gaining a lot more popularity now. As more and more people try to look to the private markets to kind of shield themselves from what's going on, certainly in the public markets this year, which have gotten killed, and just like we talked about earlier, bonds have not provided that traditional offsetting correlation effect as we've seen stocks really get hit. So when it comes to the drawbacks of these funds, we did talk about there's that 1-year lockup period, so there is some illiquidity. The fees are going to be significantly higher, and funds may have the ability to do something called gating. So if a fund gates, it means that they halt redemptions. And so say everybody tries to rush for the exit and sell at the same time, the fund can say, hold up, nobody's getting their money back. And it sounds like, oh my God, that's scary, but it really is an investor protection. Because the last thing you want to do in the private markets is have to liquidate an asset at an extreme discount. It's that example about trying to sell your car the next hour. You're going to be selling it at a fraction of the price that it's worth. So those gating features that these funds have, they're really put in place just so that they can protect investors from themselves of selling kind of at the exact wrong time. So these funds, subscription and interval funds, I really think are on the track to really democratizing private equity, private credit, private real estate, and all these other areas that traditionally were non-accessible for most people. And I will say that these funds, they have there are still some restrictions in terms of how you can buy them. Most require you to go through a financial advisor to actually get access to these funds. And the reason that they do that is that they want strong holders. Traditional or typical retail investors have a reputation for buying and selling at the wrong time. It's like, oh my God, the market's down, sell. Oh, it's way up, let's buy in. And so what these funds want, because of the illiquidity factor kind of surrounding them, is people to be long-term holders. And so they'd rather have the average person go through a financial advisor. Hopefully that advisor can kind of talk them through the tough times if things get really bad, and kind of convince them that buy and hold is the best strategy, so that they don't have kind of inflows coming in, outflows going out after they have a bad quarter. You know, they want to kind of reduce all that fund flow volatility. And, you know, the other thing that's a little bit of a pain, you know, for subscription funds, there's a lot of paperwork required. I mean, you're going to be getting pages and pages of disclosures, you know, signing a whole bunch of different forms. You know, if you do work with a financial advisor, you'll probably have to sign disclosures just acknowledging the risks of investing in alternatives just in general. So if there's a lot, if you don't like paperwork, you know, maybe consider something else. But I think that it's worth the trouble, because, you know, as we've kind of laid out, there are some real benefits here. And yeah, I think that this is the start of a real long trend. I mean, when I look at some of these private equity funds that have been fairly successful so far, kind of in the interval subscription space, you know, a lot of them, you know, maybe they're around $1 billion, and that, I mean, that's nothing in the grand scheme of things. When you look at a big kind of established mutual fund like Fidelity Contra Fund, they've got almost 150 billion in assets. And a lot of these good funds out there, they're just hitting $1 billion right now. You know, so there's a lot of growth that's going to happen in this space. And I think more and more private equity companies are going to realize that this is a great new area to get new capital from. So I would not be surprised to see more and more of the big private equity players start to put out these funds. They're going to be more accessible to folks like you and me. And so I believe that we're probably in the first inning, and that this trend is going to span multi-decades. I think right now the average retail investor at 0% allocation, you know, is going to bump up to 5 and 10 and maybe 15% over the years. And I say that from experience, like kind of running a financial advising firm myself. I think over the next 5 years, we're probably going to build, you know, 10 to 15% allocation into alternatives for most of our clients. And again, that's not a recommendation for you. You've got to put that in your own context, but just a real world data point of what, you know, financial advisory firms are doing. You know, so really just wrapping things up here, you know, the main benefit that I hope you can take away is that the potential to improve the risk return profile. You know, think potentially less risk, more return. You know, it's certainly not guaranteed, but the data supports that that kind of characteristic can be achieved in alternatives. And that's a really powerful point, because that's what you want to do with your portfolio: less risk, higher return. You know, these funds that were once really, you know, you had to have a private yacht, private jet, and all that stuff to get invited into these funds. You know, they're opening it up to the masses. And like I said, it's the very early stages, and that's really exciting. Along those lines, you know, those minimums of 250,000 are really being taken down. A lot of these funds now, it's 50,000 is kind of the minimums I see for most of them. But again, some as low as 2,500. So they're really kind of starting to be geared towards the mass affluent. And finally, yeah, you've got to access most of these through an investment advisor, just for the reasons I described. You know, they want strong long-term holders, not people kind of jumping in and jumping out. And again, it's the first inning, and I think that it's not just a fad. I think it's a long-term trend, and like I said, we're in the very early stages of that right now. So hopefully, you know, the information you're getting today, if you want to get involved in this area, I think you'd be an early adopter. And I think that there's a ton of benefits you could be taking advantage of. And yeah, I think that's about it here. I've exhausted all my points. So I'll turn it back over to Marche.
All right, great. Well, we're going to open the floor up now for questions. I will tell our viewers you're welcome to go ahead and chat those in the chat as we talk today, and we'll try to get to as many as we can. So here's a question. As these thresholds are lowered to more common investors, I guess I would say, do you anticipate that there'll be more guardrails put up as far as like the SEC is concerned or other regulatory bodies?
There's already a fair amount of regulation around these funds. Some of these funds, interval funds in particular, the SEC requires them to redeem up to 5% of the total fund value every quarter. So in cases like that, if 10% of people tried to pull their money out, they'd only get 50% back in any given quarter. But 5% a quarter, 20% a year that's pretty good liquidity, and that's a pretty good protection. And so there's other rules around how the fund is diversified, how fees are charged, depending on the fund structure. So there already are a fair amount of protections in place. And I don't see a huge kind of regulatory hole in this area. I mean, it's not like crypto or it's like the Wild West out there. There are still a fair amount of kind of rules surrounding this stuff. So there may be some modifications, and like everything, we'll probably see some fund companies maybe try to abuse this system because they see it's an opportunity for rapid growth, and that always kind of brings out the bad actors in people. But in general, I think that this is a well established space with kind of good regulatory framework to just grow from here.
All right. Well, speaking about bad actors, I had a question about how perhaps an investor might be cautious about the type of funds that they're looking at and how to tell if it might be maybe a junk one as opposed to a high quality one. Can you talk a little bit about that?
Yeah, I mean, it's tough to assess that because what you really need is access, and you don't have a lot of access in this area, unfortunately. I also think that's why a lot of these funds require you to go through a financial advisor. Presumably that advisor has done appropriate due diligence on the fund. And, like I know just from my own experience, like for funds that we're thinking about investing in, I've gone out and gone to a due diligence conference that they've held. I've been able to meet the portfolio manager, meet the CEO of the company, really dig into the strategy, make sure that these people have a character that I trust, ask kind of pointed questions about like, how are these assets priced? Who's pricing them? Are there any conflicts of interest? Are you invested in the fund? Things like that. So what you're really looking for in a good private equity manager is a good track record. First of all, you want to understand the strategy. Does the strategy make sense? And really somebody that is trustworthy, because they're a steward of capital. They're going to be handling millions and millions, maybe billions of investor dollars. So you want this person to certainly be ethical and trustworthy. But how does the average person assess this? Most people aren't going to get an invite to Blackstone's due diligence events. So, I think you really have to trust on a financial advisor that's done their homework, in these areas. And it's a good question because I've evaluated funds that I feel are not doing a good job, because I think that they're just throwing a bunch of private assets into a fund because they say, oh, wow, retail investors are going to eat this up. Let's just make this fund. I don't think the strategy is well thought out. I don't like the investor controls around it, but they know they're going to get a lot of investor capital flowing into the fund. So when I see that, when I think that it's just kind of a money grab and it's not a long-term sustainable strategy, I run the other way.
All right. Just a follow-up question to that. You said that one of the questions you ask is, are you invested in this fund yourself? So tell me a little bit about why that question's important.
Yeah, I think that becomes an alignment of interest question. And like, I would feel better at night knowing a fund that I'm invested in, is it that the portfolio manager of their fund, that he or she has a lot of money invested in that fund, because then they have a vested interest in making sure that the performance is good, because it's their financial kind of future is at stake as well. So I see that as a good way to kind of align investor interests with the fund manager interests, is that when they're invested, side by side along me.
All right. Well, thank you so much for your questions, everyone. And if we didn't get a chance to get to them, we'll make sure someone reaches out to you after today's event. We want to thank Ethan for being here and for the organizations that have made this webinar possible today. On behalf of Advice Chaser, to our attendees, thank you so much for attending. Look for an email soon with a link to the replay of this event. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.